Welcome to Andersen webinar on Pillar 2. We'll be talking about some of the key insights that the UAE bringing out there, considering the UAE launched recently, the top-up tax within the UAE with effect from 1st Jan 2025. My name is Anurag Chaturvedi. I'm the managing partner of Andersen in the UAE. And today, I have a privilege to be along with my colleague, Prateem Sengupta, who is a partner and leader for the corporate tax in the UAE. Prateem is following up on the key development that's happening around the corporate tax and the Pillar 2 in the region, and he's supporting a number of multinationals on this key topic. So we'll be diving down into more insights about this entire topic. And the key takeaway from this particular webinar is going to be like understanding the key concept that is Pillar 2 and understanding a rule about DMTT. We'll understand how the UAE domestic minimum top-up tax is going to impacting the businesses and MNC within the region out here. We'll discuss about the implications of the Pillar 2 and DMTT on the multinationals. And we'll learn about the key actions that one need to really adopt within the business to sustain these changes within the business. So now with that further ado, I would like to, ask Prateem to take it over.
Thank you, Anurag. And, good morning, everyone. And thank you for joining us for this wonderful session. Before I dive into, the key technicals about what UAE has introduced, I think it's very important to kind of take people through some of the basic concepts about Pillar 2. People are aware that, this is a global minimum tax and, of about 15%. But how do countries achieve that? Now, people are aware that, there's something going on, but what is going on, right? And basically, it's all been driven, by an inclusive framework, which has been, the forefront has been OECD, and there've been about 135 plus countries who've committed to it. Now, the way they achieve the 15%, the minimum 15%, is through different rules. So, and each country that has committed to Pillar 2, it's not like OECD has said global minimum tax 15%, then it applies to every country. Each country is supposed to take a step towards it. And UAE is now recently taken a step towards it. And like I mentioned, there are three rules, right? One is a IRR, which is income inclusion rule, which is more of a top-down approach, where the ultimate parent of any kind of multinational has the taxing right. So say the parent is in Japan, the subsidiary is in UAE. Now UAE's tax rate is not 15%, it's 9% for now, but going forward UAE has introduced something. That means Japan, where the UP is located, would get the taxing rights for that 6%, 15 minus 9%. That's the first one. That's the primary rule. The next rule is, I mentioned holding and subsidiary right now. So there could be a mechanism where a country can collect the 6% delta without there being a holding structure in place also. I'll show an example, but this is the most controversial rule out there. Many people have heard that US have are going to take steps against Pillar 2 rules. It's not all the rules. It is this specific rule called UTPR, under tax payments rule, where a lot of countries and a lot of taxpayers feel that this is extraterritorial. By extraterritorial, the meaning is that a country should not have taxing rights where they should not, ideally. So this is the rule that US is trying to challenge.
Yeah, because ultimately, like if you're not holding the structure out there, if you're not based out of holding, then ultimately the UTPR should ideally need to look into very different perspective. Yeah,
exactly. And a domestic top-up tax is exactly the opposite of IIR, where instead of the taxing rights going to UP, it will stay with the country. So like UAE's introduced that so that they don't lose out on tax revenues. And this is what UAE's announced. IIR and UTPR has not yet been introduced in the UAE. And we need to look at what's happening. But UTPR, there's a huge question mark on it, given the recent developments and whether UAE will itself bring it out or not. Now, coming to the example in the next slide, just to, I think for the viewers to understand, there's a lot of text, but just say, there's an FCO, that is the UPE in jurisdiction, F. FCO holds CCO 100%, UCO 100%, ACO 100%. Now, CCO has not implemented anything in Pillar 2. Okay, and it's a low tax jurisdiction. By low tax, I mean a jurisdiction where the tax rate is not 15% is low tax. UCO, you could say UAE, okay, it could also be a low tax jurisdiction before Pillar 2, but has only implemented DMTT, right? And ACO, any other country which is a high tax jurisdiction, has implemented IIR and UTPR. Now, this is a bit complex, but very honestly, say if FCO has legislated IIR, which is the first rule, then it can collect top up tax from UCO and CCO. It will not collect from ACO because ACO is already a high tax jurisdiction. It will collect from UCO and CCO. But because UCO will be subject to a DMTT, FCO, there can be a tax credit mechanism that FCO can claim for the top up tax that UCO pays. But assuming FCO doesn't have an IIR, this is where UTPR becomes controversial. Effectively, ACO, even though it doesn't have a shareholding in CCO, can collect the top-up tax through UTPR mechanism. So this is where the extraterritorial nuances come in, that even without having a shareholding, a country that has legislated UTPR can collect a top-up tax. Saying that the different kinds of top-up tax, there is something called DMTT, the terminology is QDMTT, and then there is also Safe Harbor QDMTT. So DMTT, if it's just DMTT and it doesn't qualify, and you need to qualify, it's qualified domestic top-up tax. If it's DMTT, you will not get a tax credit. So FCO cannot get a tax credit, simply put. Only a QDMTT can get a tax credit. But if you are a safe harbor QDMTT, you have to meet certain conditions from OECD to qualify for safe harbor QDMTT. But if you're safe harbor QDMTT, then you completely switch off IIR. So then FCO in this example would not have been able to apply IIR in relation to UCO if this was a safe harbor QDMTT.
I think it's quite a complex ifs and buts situation out there in this particular situation, because I think there are multiple jurisdictions around the world that is basically taking things forward in that relation. I think the more development in that region, I mean in this relation specifically on these application of these principles need to be looked into globally. Yeah,
definitely, and we need to see where UAE's DMTT lies, whether it's a QDMTT or safe harbor QDMTT. Preliminary view is that it is likely to qualify as safe harbor, but we have to wait and see. There's some checks and balances. Interestingly enough, OECD in January released a list of countries that have a qualified IIR and a qualified QDMTT. Earlier, the process was quite detailed. They have come out with a transitional list. So if you look at the list, it's quite obvious, this is IRR, that Europe is leading the way in the list. There's some countries other than Europe. It's mainly Australia, Japan, Korea, Vietnam. But Europe is leading the way. The rest, and this is only till 2024. The list is yet to be updated with 2025. So the Middle East countries will come in soon into the list. Safe Harbor QDMTT also is a similar number of countries, and similar one interesting country that stands out is Barbados, which is again in the Caribbean, and which has implemented a QDMTT. But yeah, Caribbean countries are not far behind. They're not lagging behind. And historically, people, even Cayman Islands and BVI have committed to this. And I think that is very important for the viewers to know that eventually they will also come out with some sort of Pillar 2 legislation.
Because it's a very rightly point that you touched with, Prateem, because a lot of UAE businesses, they have a kind of holding structure based out of these jurisdictions.
Yeah.
And the common belief right now is that if somebody need to walk out of situation, then probably these jurisdictions can be a very safe place for a temporary period.
Yeah.
But it's important to understand that the PE rules also that comes into the picture, right?
Yeah. And coming to Middle East, as an update for Middle East, UAE is now announced this, and DMTT is effective from 1st Jan 2025. Bahrain had already done it. Kuwait has already done it. Oman is not DMTT. Oman is at IIRR. which is a bit different from other Middle East countries. Qatar had a domestic legislation which included the DMTT concept, but yet it's pending final approval. Saudi is the only country where I think we are waiting some sort of announcement on legislation. But everyone, all foreign companies anyway in Saudi are taxed at 20%. So it's above 15%, but we have to wait and watch what they're doing going forward. But Middle East has now taken a call to move forward with Pillar 2, and it's happening. Everything has happened over the last few months in the Middle East. Moving to a timeline, UAE is itself, just spending a bit of time here. UAE had amended their local laws, UAE corporate tax law in November 23 to include the definition of top-up tax and multinational enterprises, paving the way for something to come in. Then in March 23, there was, I think this is supposed to be March 24, but on March 24, there was a public consultation, released to invite the public, this is what we're planning. And they've taken all those recommendations on board. On 9 December, the 9 December seems to be a very happy date for UAE Federal Tax Authority, because that also, if you recall, 9 December 2022 is when corporate tax was announced.
Yeah.
So that's when an announcement happened that top-up tax will be introduced, and also some incentives will be introduced, which I'll speak in the next slide. And then, of course, in Feb, we're all aware that over the last few weeks, there's been a lot of there's been release of the detailed rules, which we'll cover in the next few slides. Now, coming to the incentives, right? And I think, Anurag, this is very important, that the two incentives that UAEs have kind of promised, we are yet to wait for the detail as to how it will work. One is an R&D incentive, which is expenditure linked. This is about 30 to 50% of the expenditure. It's a refundable, kind of a incentive. It's very critical, UAE is trying to align this with OECD rules as well. The Frascati manual, important for Pillar 2, and I'll tell you why it's important for Pillar 2 as well. But this is something to watch out for. And the second is also high value employment activity, refundable tax credit, which is basically a percentage of eligible salary costs, and especially, C-suites and executives, strategic decision makers, basically, that are based in the UAE. This is supposed to be effective from Jan 2025, while the R&D from 2026. But we're waiting for further rules on this.
Yeah, I think that's a very important point that this rule has basically taken up. The reason for that is basically a lot of multinationals are coming to UAE right now, and there's a lot much happening around in the space of technology, AI, a lot of gaming related objectives that is coming to UAE as well. So there's a lot of research and development that's going to happen, and I think authorities are looking at the real sort of substance driven R&D expenditures, because we all understand that how the tax incentives work out there. So essentially, it's very important area there where the businesses need to really plan, and they can really take a lot of advantage of having a right sort of structure around these R&D activities to take the advantage in the future ahead.
Yeah, and I think this is also linked to how R&D is given a benefit in the free zone laws of corporate tax as well, and we need to look at that, and it's all substance driven. Yeah, and now I think let's get to the meat of the presentation. You can say the prime cut. Sorry to all the vegetarians out there. I just made a non-vegetarian reference, but yeah. So coming to the introduction, so the rules that UAE has, kind of legislated are very, very closely aligned to what OECD rules are, and it kind of has to be from a per se to get this benefit of safe harbor QDMTT. There are very few variations that can happen. So again, when it comes to the threshold, right, they've kept it at 750 million euros. Check it 2 out of 4 years. When it comes to scope, because it's a DMTT, okay, so you check the threshold at an MNE level, at a consolidated level. So whether you're consolidating in UAE or whether you're consolidating outside UAE, you check it at that level. But the tax will apply only to UAE entities. Now, which are those UAE entities? It could be a normal legal entity, constituent entities, but it also covers joint ventures. So any joint venture that is held, 50-50, it's covered if it's within the UAE. And there are also something called a minority owned constituent entity, which we MOCE that we call it. It's highly technical, but it's any entity that's held up to about 30%, but needs to be a constituent entity. Means the definitions kind of say that needs to still be consolidated. So mainly, and it also covers the scenario of PE. So a foreign company that has a PE in UAE, that would also be considered to be a UAE entity for the purpose of Pillar 2.
I think that's very important because considering all these Cayman and BVI structures,
Yeah.
probably
so
could,
and kind of the fine reading is that we'll also have to look at if those entities have a poem in UAE, whether that will capture them within these Pillar 2 rules as well. So mainly this is what are the entities. So UAE entities, whether it's JVs, normal legal entities, or your minority owned constituent entities. There are some exclusions for government entities, international organization, non-profits, pension, investment funds. Sovereign wealth funds will not be taxed at their level. It'll be taxed at the investee level. So if they're holding another entity that is a parent entity, it'll be taxed at that level, not at the sovereign wealth fund level. Now, when it comes to this, you need to be first an MNE and you need to be an MNE group. And if you look at the definitions, you have to consolidate for this, right? And consolidation becomes very critical. And I think, Anurag, would you want to touch upon what is, consolidation and how it works in IFRS?
Yeah, I think very important topic that businesses they are looking into. When the Pillar 2 situation comes out there, everybody need to be really understanding that when the threshold applies to the consolidated entity itself, and when we look into the consolidation, then it's IFRS 10 that comes out then picture, which replaces IAS 27 and SIS 12, special purpose entities. The key concept behind this entire thing is that the control. How do we define the controls, that entity which exercise the control over its subsidiaries or CEs basically, and the control is not just predominantly means that you own 51% or the majority stake out there, but it's predominantly driven from the fact that how do you exercise the entire control, because there can be scenarios such as, let's say, you have a JVs, or you have certain structures whereby through different arrangements, though the equity structure is slightly different, but you still exercise the controls. When you still exercise the controls and you control majority of the decision, even in the unanimous category or probably in solely itself, then your entire the structure of the consolidation need to be looked into. So when we look into definition of IFRS 10, it talks about some of the conditions which defines out there, which is power over the investee, which means ability to direct relevant activities, the exposure or rights to variable return from the involvement with these investees, and then ability to use this power over the investee to affect its return. So essentially, in a nutshell, if we try to see that it boils down to the fact that how much level of degree of controls that the parent entity exercise over its affiliates, its subsidiaries or associates, and then probably that defines how this entire consolidation can work. So I mean, when we look into the Pillar 2 implications, I think we need to analyze all these relationships much more in detail. Probably many times on organizations does not define these things in their constitution. So probably a deep review and deep dive of the constitution really can define that some of the left out entities can still be part of this consolidation. So I suggest that we need to look into these arrangements and relationship much more, but deeper insight between the holdco and the subsidiaries. Yeah.
And I think yes, and I think what is a constituent entity, whether it's consolidated, these things become very critical. And I mean, when you look at Pillar 2, right, financial reporting becomes so important, because when you start the Pillar 2 calculations with your IFRS financials and whether you're consolidating or not, I think it's a very important aspect, Anurag, that you've highlighted.
Yeah, and I think I remember one more touch point I want to say about it. When we first time did the CBCR reporting here, or when we done the first time implementation of the VAT and the corporate tax, now a lot of time there are a number of entities which is lying there, maybe like non-operational.
Yeah.
but still those entities have certain sort of degree of expenditures, and those entities are not in day to day have been looked into. So I think like such kind of relationship need to be looked into much more detail
Yeah.
to really ensure that we stay compliant along with it. Yeah.
Moving on, just because you meet the 750 million threshold, that doesn't mean Pillar 2 will apply to you. There are some kind of safe harbors and exclusions given in the law so that companies can transition into this. So I think one is applies, and effectively it's only for 2 years, 2025, 2026, if you look at the way it's worded. But it's called transition in CBCR, where the 3 tests that if you meet, the test, your top up tax will be 0. One is a revenue test, that your revenues in the UAE is less than 10 million euros, and the profits are also less than 1 million euros. Then the simplified ETR, it basically is that your ETR in UAE, so all the UAE entities, is more than 16% in 25 and 17% in 26. Or your routine profit. What they mean by routine profit is a percentage of your tangible assets or a percentage of your payroll cost. There's something called substance-based income include, which I'll touch upon later. But if your profits are equal or below this, then either of those tests, right? If you meet them, your top-up tax will be 0. So it depends. You need to really test whether you meet these conditions or not. Now, this is for 2 years effectively. There is also permanent safe harbor or an exclusion where they say that if your average revenue, again, the 10 million, and your profit of 1 million in the UAE, right? For the past 3 years, that is current year and the 2 past years, if the average revenue and profits are below 10 million or 1 million, then you will not have to pay top-up tax in the UAE. Now, for UAE M&E groups, I think the next point is very important. There's an exclusion for initial phase of international expansion. So if you're a new multinational and you're present in 6 or fewer countries, and the value and the net book value of your tangible assets outside UAE, assuming that your UAE assets are the majority assets. If the tangible assets outside UAE is 50 million, up to 50 million euros, that is, then you will get a benefit of this international. Then you get an exemption from top up tax for 5 years. So it's an exclusion. So if you're in an international phase of expansion, going to see whether you meet these thresholds or not. And a UAE entity cannot be held by any parent entity that has QIR status. So the 3 conditions: your parent cannot have QIR, you need to be in 6 or less countries, and your value of your tangible assets outside UAE need to be up to 50 million euros. Substance-based, I think a lot of people are familiar with this. So when Pillar 2 is what? A tax on certain kinds of income. You arrive at this income by making certain adjustments. One of the reductions from this income would be substance-based, where they're saying that 5% of your payroll and 5% of your tangible asset cost in UAE, you can reduce from your income. But there is also a provision that over the 9 years, it'll reduce to 5% over 9 years. First year, it's 9.6 for payroll and 7.6 for tangible assets. It'll slowly reduce to meet 5% in 9 years' time. So this is a significant, reduction from the income, and for entities that have a lot of substance within the UAE, I mean, this could
generally the payroll cost account for 30 to 35% of your overall cost. So out of 35%, 9% of that, and then essentially, it's quite can be significant amount. Yeah.
I think it is definitely an exclusion that, when you get to the nitty-gritties, you have to look at how much benefit you're getting from this. Now, coming to top-up tax calculation, of course, it starts with you first figuring out your UAE ETR, effective tax rate. That is done by broadly, we'll not get into the depths of it. We will release a separate publication covering what the law is and our interpretation of it, and more insights into it. But mainly it is your current tax or tax liability that is in your financials, and divided by your income, your Pillar 2 income or loss. Now, when I mentioned that, and then if that is below 15%, then you have to obviously pay a top-up tax. And the top up tax is on an excess income into the top up tax percentage. So the top up tax percentage is nothing but your 15% minus your ATR, and your excess income is your pillar 2 income or loss less the substance based income exclusion. And very interestingly, the adjustments to your while arriving at your pillar 2 income or loss, so you start with the financial income, are very, I mean, it's not very different from what the corporate tax law adjustment says. So UAE has been a bit ahead in that way that they've aligned corporate tax adjustments, kind of. I'm not saying everything's same, but there are some similarities here. But you should also look at what the dissimilarities are, because there your tax accounting could change. So you might have to look at your current tax, deferred tax separately for pillar 2 as well. And very important, when I mentioned the R&D tax credit and the employee tax credits refundable, UAE is trying to make this a qualified refundable tax credit, so that this tax credit doesn't go on to reduce your ATR in UAE. It will not reduce your ATR, even though it's a refundable tax credit. It will not go on to reduce. So in effect, it'll increase your ATR in UAE. That way you have to pay less top-up tax. How they'll treating is that the tax credit amount will be treated as an income. So eventually the exposure is reduced. They'll treat it as an income, but they'll not adjust your ATR here accordingly. Moving on, I think to wrap up, there are interestingly some interplay with corporate tax provision, the most important being GAR. They have said that GAR could apply to Pillar 2 rules as well. So any group that is looking to restructure will have to keep general anti-abuse rules in mind.
In check.
Yeah.
I think this is important aspect, because the GAR, like a lot of people's understanding is that any sort of movements after the enactment of the law can fall within the ambit of GAR, but just like in our experience, that what we've seen out there, a normal business movement, which is like normal parlance of the business, and it is essential part of the business, probably will not trigger the GAR. So one need to really look into that. What is this really a new movement that a business is planning out there?
Yep.
How this fall within the normal parlance of the business and your plan and execution strategy. So I think that's one aspect that need to be thoroughly analyzed. Yeah.
And of course, there are filing and compliance requirements as well. You have to, so the way the law reads, you have to file a top-up tax return within 15 months of the fiscal year end. So if it's Jan 25, it applies to you. So within 15 months, but it's 18 years for the first transition, 18 months, sorry, for the first transition. So it'll be June of 2027.
Yeah.
Okay.
But Prateem, one key question out there, like, when we look into all these MNCs out there and multinational entities out there, they have operations all around different countries, different countries' rules that we need to be checked out there. Do you think a very essential need for the tax sharing agreements within the businesses out there, which is quite a new norms that is coming out here in you? I mean,
it is. I think when I mentioned, so tax sharing agreement is an important concept, because that's can be driven from UAE corporate tax groups as well, where groups have to identify how do you contribute to taxes, but also how Pillar 2 affects these tax sharing also has to be looked at. Even when it comes to third party, when I mentioned the JVs, right? What we're practically, and when we're working with different groups out there, we're seeing that if one JV partner, say their JV which has to pay top-up tax, one JV partner, and that JV is subjected to top-up tax because one JV partner is subjected to Pillar 2, but the other JV partner is not subjected to Pillar 2. So the other JV partner is saying that, you reimbursed me for this Pillar 2 tax.
Yeah, and these kind of agreements that have been written long back now need to be reassessed, need to be relooked into that. Within, I was also having a conversation with some number of clients out there who are quite large entities, and what we realized that most of the auditors also start asking about these tax sharing agreements along with it, because that becomes very critical part of the tax disclosures within the financial statements as well. So it becomes one of the critical need that businesses need to planning out there, looking into their businesses, looking into the subsidiary holding structure, OCs and MOCs and things like that. Yeah.
I think we need to look at how those agreements, first I think people need to move on these agreements, and then how Pillar 2 affects these agreements, right? We need to look at it. Now, like I mentioned, there would be also registration requirement for complying with Pillar 2. Rules are yet to be announced. There seems to be a separate requirement to file a Pillar 2 return as well within 15 months. So we'll have to see. There seems to be a two-level filing requirement under Pillar 2. Broadly, these are the compliance requirements and, a summary of what are the features of this UAE domestic top-up tax. Now, what are key takeaways, right? Whether this top-up tax introduced by UAE is a qualifying or non-qualifying safe harbor or not, I think it broadly aligns. We have to wait for OECD to update UAE as, whether they include UAE as a safe harbor QDMTT, but the initial feeling it will. It is, and we need to wait and watch for that. Potential impact on free zone CT benefits. So there doesn't seem to be an exclusion for free zone entities. So effectively saying that if you are an M&E group, which is above a certain threshold, and if you have a free zone entity getting the 0% benefit, Pillar 2 can come and, kind of take away the benefit or tax you up to 15%. But yes, if you have substance in the UAE, you can get those substance-based income exclusion. You can look at these R&D tax credit or these high-value employment credits. So, and you also need to look at whether you meet those safe harbor, whether you're subjected or not. So it's not all loss. I think a detailed study would be required. Of course, this is a move to retain the tax revenue within the UAE and not to lose out on any other country. Again, coming to the same point, groups have to kind of maximize looking at getting these substance-based incentives and these exclusion, especially this initial international expansion exclusion that is there. And it's very, very important for UAE MNEs to look at this. Compliances, this is going to be a separate compliance. The kind of data points that Pillar 2 requires is quite heavy, and digital needs would be quite the requirement. And I think a lot of groups will have to look at technology solutions for Pillar 2 compliances, because the kind of data points and the kind of compliances are now getting more and more complex with this Pillar 2 introduction. And of course, look at how your deferred tax and your current tax disclosures and calculations change with this DMTT as well. Coming to this, I think we can talk about the next steps for MNEs and what they need to do.
I think Prateem, you summarized pretty well about it. That this, I think the law is quite detailed in relation to the businesses, and there's a lot of nuances, a lot of exemptions, a lot of conditions linked incentives, and I think conditions for inclusion, exclusions are there. What we have seen out there with businesses that the entities whom the Pillar 2 applies, they started to work on all these countries and start to look into that respective countries, how they coincide, and their agreement along with the UAE, how that really impacts. So a quantitative and qualitative impact assessment is something that is very, very key. The second thing is that, as we slightly touch base on the, tax sharing agreement. So, I mean, we need to look into all these existing relationships, try to identify whether those relationships fall within the ambit of M&E relationship, whereby you fall within the ambit of, Pillar 2. Those need to be reviewed again and probably, revisited again to really align with that requirement. We need to also understand that how this DMTT impacts the businesses and what the exposure it has on the UAE business. Is there any way to make your existing ETR more efficient by looking into the provisions around it? Obviously, like on top of every single thing, I think data readiness is something very key. I mean, many times we understand that we'll get ready, but trust me, friends, that I've seen along with businesses that when they are going for the first time, even the transfer pricing, a lot of people were not even ready, and they ready to understand about how this transfer pricing should be implemented and inculcated within the business supply chain. So I think from a Pillar 2 perspective, it's much more deep, it's much more exhaustive. So data readiness is something which is very key, and one need to look into that. We are doing a lot of training and awareness about the Pillar 2, how respective areas of the business and functions within your finance and supply chain and the relationship across the businesses get impacted by the Pillar 2. We can help you out to develop the strategies for your compliance and adherence to the Pillar 2 all around the globe. Andersen operates in 170 plus countries, so we have offices all around the world. So we are happy to support you in that relation.
I think, and Anurag, I think very importantly, I think staying informed is a very important, because this is a changing landscape. It's changed so much over the last few years that I think, I would urge all viewers to just keep a tab on our socials and see what is happening around Pillar 2, and, and the updates, and whether itself just a small thing, whether it's a safe harbor Q, DMTT, what are the other compliance, what are the forms or the registration timelines, because Bahrain brought out this registration. They did not give much time, and the penalties are hefty. It's up to 1 million dirhams. So it could result. So I urge all viewers to kind of stay tuned for any further updates on this. We can now, I think, just take up a few questions, that we have in the chat box. Someone said, just wanted to understand if the participation exemption is not available for investments under 5%, but below 10% shareholding. That's correct. Like when you're looking at, so this is a very finer point when you're looking at excluding dividends. In Pillar 2, when you calculate, instead of 5% in corporate tax, in Pillar 2, they look at 10%. 12-month criteria is the same, but this is where there could be certain mismatches between Pillar 2 and corporate tax, where something could get excluded for Pillar 2, but not excluded for corporate tax. So that's where tax accounting measures could, tax accounting numbers could change. There's another question. If a UAE-based group, all companies in UAE are subject to Pillar 2? No, for now. So if you're just within UAE and you're just purely a domestic group, UAE has taken the legislative action of not taxing. But again, if you need to look at how it's structured, with general anti-abuse rules also being interlinked with corporate tax. We'll have to look at the structures and see whether you're purely UAE group or not. Any other question? Okay, I have a question regarding substance-based income for leased assets, operating ROU assets. Okay, the question is broadly, what I understand is whether ROU assets would be included in the Pillar 2 computation with the tangible assets. For now, it appears that ROU assets would be counted as a tangible assets, but there are certain complexities within the rule. But broadly, it should be. You can reach out to us to understand the finer points towards whether ROU assets will be considered tangible assets or not. But broadly, yes, but with certain nuances. I think we right now, in the interest of time, we have only, we can only take up, so many questions. Again, thank you all for joining in. If you have any other doubts or any other queries, do feel free to reach out to us.
Thank you so much for the time, and stay tuned for more updates on Andersen. Thank you.